Hi CA students, let's revise CA Final AFM Chapter 8 Mutual Funds Practical Question 16. Sun Moon Mutual Fund approved mutual fund sponsored open-ended equity oriented scheme Chanakya Opportunity Fund. There are three plans: A dividend reinvestment plan, B bonus plan, and C growth plan. At the time of initial public offer on At the time of initial public offer on 1/4/1999, Mr. Anand, Mr. Bachchan and Mr. Charu, three investors invested 1 lakh each and chose B, C and A plans. So Anand chose B, Bachchan chose C and then Charu chose A. Written accordingly. The history of the fund is as follows. They have given from 2003 till 2009 they have given, and the initial public offer was made on 1/4/1999, and that time only those people also has invested. Now on 31st July all three investors redeemed all the balances, so which is nothing but this date 2009 31st July they redeemed all the balances. Calculate annual rate of return to each of the investors, and they have given some assumptions, so we have to stick to these assumptions. One is long-term capital gain is exempt from income tax. So as we can see in the last two differences were within the year, so whatever is coming this within this year will be considered as short term. Others, whatever the reinvestments, all those things will not be considering, as it will be a long term capital gain. Hence it is exempt, so no need to calculate tax on that. Short term capital gain is subject to 10% tax, so we have to stick to this 10%. And then securities transaction tax 0.2% only on sale or redemption of units. So only on sale or redemption of units we have to take. On reinvestment and all we should not calculate. So only during the end of end when they redeemed, right, all these three people they redeemed on 31st July, that time only we have to calculate STT and ignore education cess. So no need to calculate plus 4% or anything extra. Just stick to this 0.2% only on sale or redemption, or and short term capital gain 10% tax has to be reduced to arrive at the NAV and calculating the annual rate of return. Now going to the solutions, we have to split this into three plans, as we have three people, Charu, Anand and Bachchan. First, plan A was taken by Charu. Charu plan A, so we'll be taking that. And since it is a plan A is nothing but dividend reinvestment plan, so whatever dividend we are receiving, it will get reinvested again into the mutual funds. So the number of units will get added at every point when the mutual fund, the Sun Moon mutual fund, is issuing dividend. So in the given case, as we can see, Sun Moon has given dividend during these dates, so only those dates will be taking, and then those dates will be taking. Initially the investment was made around 1 lakh during 1/4/1999, and then the NAV was 10 as given in the problem, where they have given three investment each 1 lakh. Yes, face value 10 rupees. So 1 lakh into 10, 1 lakh is the value invested, divided by 10 will give us the number of units, which is 10,000. So closing also will be 10,000. Next, on 28/7/2003, after 4 years, for dividend of 20% has been issued. So this 20% into this 1 lakh will give us 20,000, which is the dividend. That dividend divided by the NAV as on that date, which is nothing but 30.7. So 20,000 divided by 30.7 will give us 651 units. This one is the additional units invested in mutual fund. We are not taking this dividend, we are reinvesting in the business. So 20,000 divided by NAV as on date, we will be purchasing the new mutual funds. Will not be purchasing, it will get automatically reinvested whenever the dividend is issued. That's what is this reinvestment plan. So 20,000 divided by 30.7, 651 will get added to Mrs. Charu's closing units, 10,000 plus 615. Same way, in the next year, 70% was dividend was issued. So 70% of the existing mutual fund units. Here, the existing mutual fund units is 10,651 multiplied by 10 will be 10,000. Sorry, 1 lakh 6,514. So this multiplied by 70% will be the dividend, 74,560, and NAV as on that date is 58.42. So 74,560 divided by 58.42 will give us 1,276, which will get added to my closing balance. Same way, the next year 2007, 40% dividend was issued. So this will be on 11,927.75 multiplied by 10 on that 40%, because on the face value only they will give dividend, right? So then 47,711 divided by 42.18 18 will give us the number of additional units. This again will get added to the closing balance of units. Then the same way continues for 2008, 28%, 25% dividend on this 13,058 multiplied by 10. So 32,647 is the dividend that is received, and which will again get reinvested as on that date's NAV, which is nothing but 46.45. So 702 units will get added to the existing closing balance, 13,761. On the last day, like before the redemption, 24/3/2009, 40% dividend was issued. So 13,761.73 multiplied by 10 into 40% will give us dividend during that time. Then divided by NAV will give us the additional units to be added. Now adding that to the closing balance, the ultimate closing balance will become 14,906.16. Now redemption value will be nothing but this closing balance multiplied by when we sold this mutual funds, the NAV is 53.75. So from 14,906 multiplied by 53.75 will be the redemption value. Now STT is 0.2%, as I previously told. On what portion STT will be calculated? STT should be calculated only on the only on sale or redemption of units. So here it will be on this 8,01,206, which amounts to 1,602.41. Then the net amount received after this STT will be 7,99,603.69. This much amount we will be receiving in our account. On that, again we have to pay short-term capital gain tax. That will be around 10%. So will not be paying on the entire amounts, as we have to calculate the tax on only short-term capital gain. As I previously told, whatever transaction happened before these dates, before 1 year, so will be long-term capital gain. Only during this within a year of the sale, so which is nothing but 31st July 2009. From that 1 year if we calculate, then 31st July 2008. So these transactions happened before those dates. So the those are on those long-term capital gain will be applicable, and then hence here in the assumption also they have told long-term capital gain is exempt from income tax for this problem. So hence that will not be considered. Only short-term capital gains at 10% on the recent units. Only on this 1144 will be calculated. In that also we have to calculate on only the gain. So how will I get the gain? When we got this 1144 during this 24/3/2009, at that time if you see the cost is 48.10, so which will be, this will be the investment amount, right? So 1144.43 units got added on 24/3/2009, and we sold this immediately within a year. So short term capital gains will be applicable. When I'm purchasing, the cost of acquisition is 48.10, while I'm selling at 53.75. Here they told 53.64. This is because they reduced the security transaction tax at 0.2 on that amount, but ideally there is no deduction on uh, STT to claim it as an expense for calculating capital gains. There are two ways of approach. If we stick to the income tax provision and then follow this sum, then we have to take 53.75 minus 48.10 multiplied by 1144.43 and then 10% on that. But if we see clearly that they have given these assumptions, that only these assumptions has to take place. They didn't specifically mention that short-term capital gain is not allowed as a expense like that. But anyway, they've given alternative solution also. If we see down, note they've given alternatively figure of the star mark, which is nothing but this 53.64, and then in the next one 22.93. So those and T can be taken as without net of tax, because as per proviso 5 of section 48 of IT Act, no deduction on STT shall be allowed in computation of capital gain. So that is also fine. Okay, now coming back to the question, we will calculate the short term capital gain, and then 634 is the answer. Then coming to net of tax, the amount received minus the STCG, net of tax we got, then less the investment will be the return, net return which we got, which is nothing but 6,98,969.69 in the first case. So this will be the return, and we have invested Mrs. Charu has invested 1 lakh. So 6,98,969 divided by 1 lakh into 12 divided by 124 multiplied by 100, because we need for only annual return. But as you can see, we have invested on 1999 and then we sold on 2009, so almost some 10 years gap is there. So considering that, the months, number of months, divide that by that number of months multiplied by 12 we want, so we got 67.64 as the annual average return we got in case of this Mrs. Charu's plan A dividend reinvestment. Going to the next part, plan B, which is taken by Mr. Anand, which is nothing but just a bonus plan. So whatever bonus we are getting, bonus shares in this plan, we will be getting bonus shares and nothing else. So all the bonus units will get added to our mutual fund scheme. If we see here also, the first investment is on 1/4/1999, and then there were 4 bonus issued during 2004, 2008 and then 2009. These were the 3 periods where bonus were issued. So first we have 10,000 units and the balance is 10,000, and the NAV on that date is 10. Second, during 2004, 5:4 ratio, bonus shares are issued on 5:4 ratio, which is nothing but for every 4 shares held, sorry, not shares, for every 4 mutual funds held, 5 new units will be given. So 10,000 divided by 4 multiplied by 5 will give us the bonus units 12,500, which will get added to the balance 10,000. Hence the new balance is 22,500. Same way going next, 1:3 ratio. The existing balance is 22,500 divided by 3 is 7,500. That will get added to the existing balance 30,000. Same way goes next, 1:4 ratio. So 30,000 divided by 4 is 7,500 bonus units. That will get added to the total balance 30,000. So 37,500 will be the new balance. And as on that date, NAV is 19.95. Okay. Now the since these all are redeemed on 31st July 2009, on that date, if we see, the NAV is 22.98 and the current balance we are having is 37,500. So multiply that, we will get the redemption value. On that again STT will get reduced. So the net amount received is 8,60,026.5. Then less short-term tax, short-term capital gain at 10%. Even here also the other assumption is they are telling this 19.95. This value can be taken as 0. This is because bonus shares will not have any cost of acquisition. So hence whatever the money has been received, whatever the units we got, everything will be on free of cost. So whatever the NAV as on that date, so for this 7,500 units, whatever NAV we got 22.98 will be entire gain. That will be as per the income tax, but since as I previously told, they have not specifically mentioned anywhere here for this consideration points or the assumptions, so we can just reduce it and calculate, or even they have told this can be taken as 0 also. In either ways it works. 7,000, coming back to the solution, 7,500 multiplied by this 22.98 is the NAV as on that date, minus 19.95, which is the on which we got the dividends. Bonus shares. So will give us the gain, then multiply 10% tax on it, 2,235 will get reduced to it. So net of tax 8,57,791. On that investment, if we reduce, the net gain is 7,57,791. Again the same way, this is for 124 months, so we want only for 12 months for annual average return. So 7,57,791 divided by 1 lakh into 12 divided by 124 will give us the annual average, which is 73.33 in case of Mr. Anand's Plan B bonus shares. Next, Plan C taken by Bachchan, which is a growth model. So it's a straightforward model. We will directly go to the redemption date. We will not worry what has happened in between, as we were just taken the growth model. So from starting, let's say the NAV as on investment date is 10, and then it got growed into 82.07. so this gain only we will be taking, that's it. So 10,000 is the number of units we invested, multiplied by the latest date on the date of sale. The NAV is 82.07. So 10,000 into 82.07 will give us 8,20,700, minus the STT 0.2% will get reduced. The net amount received 8,19,058.6, and there is no short-term capital gain. Why? Because recently there is no reinvestments, there is no new bonus shares got added within a year. So as I previously told, within a year if anything happened, that only will come. Here nothing happened, so short-term capital gain is 0. Net of tax, then investment we will be reducing from here. The net gain is 7,19,058 divided by 1 lakh, again same, multiplied by 12 divided by 124. Since the period of holding is 124 months, we want for only 12 months, so divided by 124 into 12 will give us the annual average rate for an year, which is nothing but 69.79 in the case of Mr. Bachchan. the growth model. So as we can see here, the bonus share plan gave us the more return. In case of dividend growth model, it is 67.67. In case of bonus shares, it is bonus plan, it is 73.733, and in case of growth model, it is 69.59. Thank you.